Good afternoon and welcome to today's market briefing. Let's start with the key numbers from Friday's close. Both the Nasdaq and the S&P 500 hit new all-time highs, but beneath the surface, the mood is far from euphoric. The VIX, our fear gauge, climbed to 19.05. The 10-year Treasury yield held steady at 4.32%. The dollar index was at 98.26. Offshore yuan traded around 6.8375. WTI crude oil stayed firm at $95.91 a barrel. Gold settled at $4,710.60, and Bitcoin was at $77,747.30. Now here is the big picture. We are seeing clear divergence across markets. The VIX is up, equity futures are weakening before the open, and that tells us risk aversion is building. At the same time, crude oil is holding elevated levels, and in China, the Shanghai Composite edged up 0.16% while the Chinex fell 0.52%. This divergence shows capital is rotating aggressively between asset classes. The dominant theme today is geopolitical risk driving a flight to safety and energy premiums. Money is flowing out of high-valuation tech and growth names and into energy stocks, which offer more certainty right now. Defensive positioning is also gaining traction. This logic is expected to carry through the European session and into the US Open, creating a coordinated global capital flow. On the macro front, interest rates remain a headwind for risk assets. The 10-year yield is elevated, and with the Fed meeting this week, expectations for easier policy are fading. The dollar index dipped slightly but is still supported by safe haven demand and high rates. On inflation, Brent crude has crossed $100 a barrel. Rising energy costs will feed directly into inflation data, further limiting central bank flexibility. Geopolitical risk is the key variable here. The stalemate in US-Iran talks is directly boosting the geopolitical premium in oil and pushing the VIX higher, which is suppressing risk appetite across the board. Let's break down the major asset classes. US equity indices are at highs, but deteriorating market breadth and weak futures are clear warning signs. We expect the rotation from tech and growth stocks into energy to continue. In China, the divergence between the Shanghai Composite and the Chinex tells us domestic institutions are playing defense, especially with external risks rising and a holiday approaching. Bitcoin is moving in sync with equity futures, behaving like a high beta risk asset, not a safe haven. In commodities, energy carries a geopolitical premium, while gold is caught between support from geopolitical uncertainty and headwinds from high bond yields. The two main capital flows today are clear. One is long energy. WTI at 95.91 and Brent above $100 are direct reflections of the Iran standoff. This thesis is hard to disprove in the short term, so fund inflows into energy are likely to continue. The second flow is avoiding or shorting high beta tech and growth names. The VIX at 19.05 and weak futures suggest smart money is reducing risk exposure. Names like ARKK and MSTR will remain under pressure. For high-frequency triggers, watch two things. First, any news out of the Strait of Hormuz. Official statements or media reports about shipping security or military standoffs will cause an immediate spike in crude and a sharp drop in equity futures. Second, watch for Fed speakers. Any hawkish comments ahead of this week's meeting could be read as a tough stance on inflation, which would hit risk assets and accelerate the rotation into defensive sectors. On the risk side, we need to watch for an unexpected thaw in US-Iran relations. If official sources confirm a breakthrough, the geopolitical premium in oil could evaporate quickly, and long energy positions could face a stampede. Also watch for tech earnings. If a major tech name delivers strong results or raises guidance, it could temporarily reverse the negative sentiment and cause capital to flow back from energy into tech, leading to an intraday-style reversal. Our trading strategy for today is hedging. Specifically, we recommend a pair trade going long energy stocks and short the Nasdaq 100. The confidence level is 75%. Entry conditions are WTI holding above 95.50 after the US Open and the Nasdaq 100 futures breaking below last Friday's intraday low. We would add to the position if Brent crude breaks above $102 or the VIX rises above 20, signaling escalating fear. We would reduce the short leg if the VIX falls more than 10% from its intraday high. We would stop out if WTI breaks below $94 and the Nasdaq turns positive, which would mean the main thesis has failed. Here are 5 verifiable predictions for today. 1. The S&P 500 will close lower, and the energy sector ETF XLE will outperform the broad market. 2. China's ChiNext will fall more than the Shanghai 50 index, continuing the divergence. 3. Bitcoin will test the $77,000 level as a risk asset under pressure. 4. WTI crude will hit an intraday high above $96.50 on supply concerns. 5. Market breadth will worsen, with fewer than 40% of S&P 500 components closing higher. Our probability assessment for today is 15% for an up day, 35% for a sideways day, and 50% for a down day. The directional conclusion is clear. With geopolitical risk as the dominant driver, capital will continue rotating out of high-valuation tech and into energy and defensive assets. Investors should maintain a hedging mindset and stay cautious at these elevated levels.